past month, the NASDAQ has been flat. I mean, you can see it on the screen. It's technically down 0.11% over the past month, but let's call it a wash. Let's just call it flat over the past month. But I think this is really telling about the current state of our stock market, because let's really think of what's happened over the past month. First, we've had real GDP growth revised for Q4 up to 3.4% as an estimation. That's really good news about our economy. Next, we continue to get pretty good inflation data, particularly with CPI minus energy and food, which for the second month in a row was only up 2.0% quarter over quarter. And if that trend continues, the overall rate is certainly going to fall to 2.0% year over year, which again is really good news for the stock market and the economy. Next, we had the NVIDIA AI event that took place from March 17th through the 21st. We got some really exciting news, really good news coming not only from NVIDIA, but a lot of other companies that have AI offerings, AI services, AI products that are going to boost our economy, boost our productivity over the next decade because of the advancements we're making in AI. As a result of this, though, NVIDIA too didn't really move, despite the really good news on the AI front. From March 7th through today, NVIDIA is technically down 2.9%. And then we have this. Despite gasoline prices going back up, inflation expectations from consumers remain very subdued. It means that consumers aren't expecting much inflation over the next 12 months, which is more good news for the economy, and it's more good news for the Fed regarding the fight against inflation. And then lastly, I'll just cover this quickly. The unemployment rate is 3.9%. It remains below 4%, which is kind of a key level when we're looking at whether or not a recession is going to come. And it looks like this Friday's unemployment report is going to report unemployment remaining below 4% yet again for another month. Really, really good news on the economic front, and as a result, it's really good news for the stock market as well. But again, despite all this good news, the stock market over the past month is flat and actually technically red. If this tells us anything, at a minimum, it means that the stock market has priced in a lot of good news and is particularly susceptible to any bad news currently. Now, throughout 2024, I've made a slew of broad stock market videos talking about my thoughts about the current state of the stock market, the longevity of this bull market we're in, etc. Every single video has had different data in it. They've been titled differently, but all in all, they fit into the same glove, if that makes sense. And up until now, I just don't think I've made a video that's really all encompassed every single one of my thoughts that I've shared throughout these videos. For example, 2 months ago, I made a video saying, warning the stock market AI bubble, how it will crash. But then just recently, 6 days ago, I made a video titled 2021-esque returns are coming back to stocks. Get ready. It might sound crazy, but those two videos have the same conclusions in them, that either we're going to enter this extreme melt-up phase in the stock market, an asset bubble is going to form, and we're going to make a lot of money over the short term, and then things are going to pop and crash, or we're going to experience short-term pain in order to see long-term gain in the stock market. And that's actually my concern for the stock market right now. Both roads lead to pain, either short-term or long-term. I particularly think one option is more likely right now, but I think the other option is better. So that's exactly what I'm going to be talking about in today's video. But really quick, if you're new here or returning and not yet subscribed, please subscribe down below. We have one of the fastest growing stock market YouTube channels on the platform, and it's thanks to you guys, this amazing community that's watching my video right now. So I greatly appreciate it. Also, let me know down in the comment section down below what you think about this. Do you agree with my thesis here, or do you disagree, and why? I love seeing all the new faces. Without further ado, let's jump into this video. So let's set the stage here. A lot of people believe that we are at interest rate levels now that are high. I actually disagree with this thesis when you look at where interest rates have been for the past 50 plus years, and you'll see that we've actually just normalized interest rates. And this is actually why I went long the market at the end of 2022 when nobody else wanted to. I believed that despite us raising interest rates, our economy would remain strong and earnings would be able to remain elevated at companies because these are normalized interest rates. It's not like we're raising interest rates to that restrictive of levels compared to historical standards or precedent. But if you look at this chart that shows the federal funds rate through time, you'll notice one thing in particular, and it's that the Fed cuts rates when things break in the economy. You can look at any time recessions have happened, and just prior to those recessions happening, some sort of crisis has occurred, and they've started to cut rates and loosen monetary policy, financial conditions, and lower interest rates to help subvert that financial crisis. So whenever you hear people say that the Fed pivots when things break, they are 100% accurate, 100% true when you look at history. However, we need to focus on the current state of things and the current Federal Reserve and what they are threatening to do. You see, what they're threatening to do is actually do a non-recessionary cut. They're threatening to cut interest rates because of the fear that they might cause something to break, and that is in direct contrast to what they've done in the past, cutting rates because something has broken. There are many reasons why this concerns me personally, but the biggest one is the fact that think of any sort of asset right now. Think of real estate, think of land, think of Bitcoin, think of the stock market, think of housing, think of gold, think of silver. Every single asset out there, despite interest rates going up over the past year and a half or so, their values are at all-time highs, which means we have asset inflation despite interest rates going up and taming down price inflation. If all of a sudden the Fed comes out here and decides to cut rates despite assets, for the most part, all being at record highs, what do you think is going to happen? Well, certainly we're going to have asset bubbles or pockets of overvaluation in the stock market. We're probably going to see a melt-up scenario in the stock market. We're probably going to see an overall bubble form, which is actually great for investors because we can make a lot of money over a short amount of time, but it's really difficult to time the tops of these such events. And the fact of the matter is, most investors aren't able to time the tops, and they end up losing money or missing out on extreme upside by selling out too early and thinking the market top is in too early. Right now, the markets are pricing in 3 rate cuts for 2024, which I think is actually a mistake. And I do think the Fed is going to wake up to this. At least I hope they do. Because if not, we are going to form an asset bubble and we're going to reach valuations that are dangerously high, and eventually all of this is going to come crumbling down. The bubble's going to pop, the melt-up's going to melt down, and we're going to feel a lot of pain for lots of months. It might make 2022's bear market look very, very small. So that's kind of scenario A. We form a bubble, stock prices soar, asset prices as a whole soar, and as a result, we see immense asset inflation, which leads to renewed price inflation as a result of the wealth effect. And whenever we have renewed price inflation, it means that the Fed's going to have to threaten to re-raise rates, likely to unsustainable levels. You know, I just talked about how people thought 5% on the federal funds rate is too high. Well, if this scenario plays out and they're forced to re-raise rates, we're probably talking about close to double-digit percentages on the federal funds rate. That is high, and that would be dangerous to the economy. Scenario B, I think, is much better for us investors, despite maybe feeling some short-term pain. You know, recently I've started to say I think we're due for a cool-off in the stock market, and we've sort of gotten that with the stock market remaining flat for the past month, but I think we need to see even more of that, because if the Fed does awaken to this likelihood they would cause an asset bubble and renewed price inflation if they cut rates 3 times this year, it likely means we see a maximum of 2 rate cuts, and the likelihood of no rate cuts begins to increase, which adds doubt to the stock market short term because the markets start to doubt interest rate cuts actually happening. In that scenario, we feel a lot of pain over the short term in the stock market, but over the long term, it's a much more healthy option where we wouldn't see a sustained meltdown of the stock market. The reason I think we're in such a dangerous time period currently is actually evidenced by this chart on the screen here, which shows Fed assets and their liquidity facilities. It's my personal thesis that as a result of the great financial crisis in 2008 and basically through 2010, the Fed learned how to rapidly establish emergency liquidity facilities for the markets and for the economy. And I think we saw evidence of this during the great virus crisis of 2020, where liquidity was increased rapidly overnight. And as a result of it, we only saw a 2-month-long recession despite the global economy shutting completely down. The recession lasted 2 short months. That to me is very telling. The Fed is playing whack-a-mole right now with their liquidity facilities. Last year, we had Silicon Valley Bank and a banking crisis that presented itself. What did the Fed do? Overnight, they announced an emergency liquidity facility. You can see it on the chart here, this great spike in liquidity in the system. And I actually think personally the Fed has done a really good job with this, playing whack-a-mole, identifying these crisis events that could broaden and cause economic catastrophe, cause economic recessions. They've increased liquidity, they've made the right decisions, but the risk then becomes if they misidentify some sort of crisis in the economy. And I think that's something they could be doing right now, thinking they need to cut interest rates in order to avoid a recession from happening. You see, even if the Fed didn't cut rates this year, I personally think the odds of seeing a recession in 2024 are minimal. They don't need to cut rates to avoid recession, but in their eyes, and based on what they're communicating to the markets by leaving 3 rate cuts on the table, they believe that it would be appropriate to cut rates to avoid seeing a recession. So although whack-a-mole is working really good for the Fed right now, it's decreasing the likelihood we see recessions, and it's decreasing the severity of these recessions when we do see them, evidenced by the great virus crisis in 2020, eventually, that's the risk I see right now. They misidentify a crisis in the system, and they add liquidity to the system when they shouldn't add liquidity to the system, and asset inflation soars, we form a bubble, we have a melt up in the stock market, and then the needle pops the bubble. And we have a huge fallout of asset prices, and we have a really bad time period of economic activity. So when I made that video the other day saying 2021-esque returns might be coming back to the stock market, it was 100% truthful. It fits entirely into my thesis here, that over the next 12 months, it could be very lucrative to stock market investors, but eventually things have to correct. And I think the risk is, as I've said twice already, the Fed misidentifying a crisis in the system, and they whack-a-mole when there is no mole to whack. On the screen here, you can see how the stock market generally follows companies' earnings. If earnings are going up, the stock market goes up. If earnings are falling, the stock market falls. However, there are certain time periods where the balance between the stock market going up as a result of earnings versus the stock market going up as a result of multiple expansion kind of gets out of whack. And if scenario A ends up playing out and we form an asset bubble, it means that stock prices have gone up due to primarily multiple expansion. Multiple expansion without earnings expansion is when you form bubbles in the stock market. This is a very rare scenario right now where if the Fed doesn't cut rates 3 times in 2024, it actually might lead to a better economy and better company earnings, which means long-term, the stock market is going to be much healthier if they choose not to cut rates 3 times this year. If you take anything away from what I just said, we want market expansion from earnings expansion, not multiple expansion. If multiple expansion happens, we form an asset bubble and all bubbles eventually pop, and that's usually when we see the worst catastrophes in our economy. I know we've gone through a lot in this video, so really quickly, I want to kind of wrap all of these thoughts together in a more concise way. I believe that economic downturns are caused by a process where as economic expansion occurs, inflationary excesses pile up in goods and services as well as assets. Think housing, think stock market primarily. And typically, when we enter these sorts of scenarios, confidence builds more and more in the longevity of the economic expansion, which means borrowers end up borrowing more money to purchase goods, services, and assets. As these purchases become more leveraged, we form the asset bubble, we form renewed price inflation, and they expose both borrowers and lenders to risk. If the Federal Reserve continues to play whack-a-mole and they misidentify a risk in the system and increase liquidity when they shouldn't increase liquidity, we're going to form the bubble. We're going to have that bubble pop and we're going to feel pain. That is scenario A, which I fear is becoming more and more likely by the day, especially the longer it takes the Fed to realize that what they're signaling to the markets might be the incorrect move long term. Scenario B is actually what I'm hopeful for. So I am biased when I say I want the stock markets to fall because I think this would be better for us investors long term. I want the Fed to take rate cuts out of the system for 2024. I don't think they're needed. And if they are needed, they can always reverse course and say, okay, we're going to cut rates. We're going to provide liquidity to the system. We've been good at playing whack-a-mole and identifying proper crises in the past, and we're going to do it again. There is 0 point, in my personal opinion, of the Fed cutting rates because they believe that higher interest rates could possibly end up causing recessions. If the Fed starts to communicate that they no longer expect 3 rate cuts in 2024, then, as I mentioned earlier, we're going to see more short-term pain in the stock market as the stock market takes rate cuts out of the equation for 2024. And we really could see a 10 to 20%, or maybe even a little bit more than that, correction in the stock market if this takes place, because then all of a sudden the stock market, instead of speculating how many rate cuts are going to happen, it begins to speculate if rate cuts will happen at all. So with that, I hope this video has kind of tied together all of my thoughts about the stock market currently. If you agree or disagree with me, let me know down in the comment section below. You can join my membership to help support me. I'm entirely self-funded. I don't take sponsorships. I pay for everything myself out of pocket. If you want to support me and get access to the perks I provide via my membership, like buy and sell alerts, macro analysis like this video today, exclusive videos, exclusive content, exclusive posts, etc. You can join my membership by hitting the join button located right next to the subscribe button, or you can go to my Patreon page, which will be linked in the pinned comment. With that, I hope you have a great rest of your day. Stay blessed, keep 10 toes to the ground and your chin up. Peace out.